Welcome to part 1 of the video titled Open Challenge to Murex. And this is the second challenge which we are throwing before a great company called Murex. You know the Murex philosophy? I tell you. Murex philosophy is very simple. And this is not the Murex philosophy. This philosophy is adopted by many companies of the world. Whenever you upload a video about Murex on YouTube, probably on the social media, they have a legal team based out in India. I don't name the law firm who is covering the Murex, and they send you a legal notice and they threaten you. 99.9% people, I repeat, 99.9% people frightened and they take a step back. Because these law firms are very big. Only name. Knowledge is zero. Only name. But these law firms do not know there is somebody known as Rahul Magan who can challenge Murex on a social platform. Well, this is Murex philosophy. And this philosophy is very clear. So when you open YouTube, you type Murex, you will see that no people made a video on Murex. Because whosoever tried, he got a legal notice. And people took a step back. But I assure you, I would be throwing so much challenge before a Murex that they failed to answer them. And today I am throwing yet another challenge. Now this is part 1 of the video. I need one more part to cover the whole story. Market is very volatile. There is no doubt about that. Thanks to Russia, the market is getting more volatile. Because of the Russia, the implied volatilities across all currencies, whether it is GBP, Euro, Japanese yen, Australian dollar, New Zealand dollar, probably all currencies, whether they are direct pairs or indirect pairs, they are up. I am saying implied volatilities are up. Now, what the hell is implied volatility? Those who do not know, although I covered this many times on our YouTube channel. Implied volatility is nothing but the expected volatility of a currency pair, rather an asset class. It could be commodity also. It could be crypto also. It could be fixed income, or it could be any other IR derivatives. So example, take GBP dollar. Today, 1 year GBP dollar volatility as I speak is near about 11%, which is fairly high. I would say fairly high because it used to be 5%, 6%, somewhere in that range, which is okay, not a bad thing. But now it is 11%. God forbid, if Ukraine falls, only the time would tell, then that implied volatility would be, oops, 20%, probably more than 25%. Now, these implied volatilities which you have, these implied volatilities impact the currency valuation. They do impact the currency valuation. Why it do impact the currency valuation? Because all the big players, those who are taking positions, example, hedge funds, mutual funds, sovereign wealth funds, the government organizations, the depository institutions, the ECN, electronic communication networks, high frequency traders, you have the proprietary traders, the big G7 banks like Goldman, JP, and all. And more than what I mentioned, they completely rely on these implied volatilities for the pricing. So today, example, if Goldman is taking a position in GBP dollar, say 1 year down the line, then they have an implied volatility in their pocket. When I say in their pocket, that doesn't mean it is fixed. It means they computed it. Now the problem is that implied volatility is either coming from their own proprietary system, because the big banks like Goldman, JP, and all, they work on their proprietary systems. They are big bank guys like Goldman having a derivative book of $1 trillion. So one bips on $1 trillion is 100 million, which means if Goldman fail to correctly estimate 1 bips, they would be losing 100 million. So if Goldman failed to estimate 20 bips, assuming, they would be losing 2 billion, which is a huge amount. It can swing their P&L like what the hell. And they are answerable to their investors. They are answerable to the analysts who are covering Goldman and so on and so forth. So they have their proprietary engines. In a later stages, we would be cover more about proprietary engines. But having said that, these proprietary engines are subject to huge interpretation issue. But who cares? And Goldman is right, because by the time they are market maker, which means one side they have buyer, another side they have seller, in between is a Goldman. I repeat, one side they have buyer, another side they have seller, in between you have Goldman. Goldman hardly bothers because they are getting the business. And this, I think, should be the forte of the business, which is you getting the money, you getting the business. Simple. But when it comes to option pricing, because in currency market, options play a very important role. Of course, in India, people hardly bother about options. In India, the definition of options is call and put. But globally, that is not the scenario, because the definition of options are deliverable options, non-deliverable options, exotic options, non-exotic options, structured payoff, first generation exotic, second generation exotics, third generation exotics, with and without quanto structure, with and without ratchet structure, with and without basis swap structure, hell lot of things. You know, guys, the big banks like Goldman, JP, Citi, they all work on first generation, second generation, and third generation exotics. The live example is you go to their annual reports, which are called 10K. You will see they have the valuation hierarchy which is given, which is L1, L2, and L3. So they will give the amounts, they sum total it. But yes, when it comes to HSBC, I'm very happy, because HSBC gives the complete bifurcation of the valuation hierarchy, which somehow difficult to get in Goldman and JP Morgan, but they still give the data. That is okay. But having said that, the valuation comes from two sources. Number one, either it is a proprietary trading machine, which the big banks own, they can afford, they have the money, they have the quants. Interpretation or no interpretation issue, that's a separate thing. Alternatively, it comes from Reuters or Bloomberg. which is again subject to interpretation issue. I'm not saying that whatever the pricing both Reuters and Bloomberg are giving, this pricing is completely correct. No, that is not at all completely correct. It is subject to interpretation issue. I raised interpretation issue to Bloomberg on their option valuation. And somehow in an open forum on my YouTube video, they failed to answer me in an appropriate way. But still, now guys, whatever the valuation you're getting of an option, whether it's a first generation option, first generation exotic, second generation exotic, third generation exotic, this comes in a system called TMS. TMS stands Treasury Management System. I have explained TMS many times on my YouTube channel, so please don't expect me to explain again. And the valuation which is coming of this option also goes to another platform which is called ERP, Enterprise Resource Planning, which could either be SAP or Oracle. So the option valuation which is coming goes to two places. Number one, the TMS, Treasury Management Systems. Number two is ERP, Enterprise Resource Planning. See you in part second of the video.